the more wealth you have, chances are the higher your estate tax bill is going to be when you pass away. And there are some very efficient ways of paying your estate taxes, and there's some very poor, very inefficient ways of paying your estate taxes. I'm going to give you an example. So let's say someone owes $1 million when they pass away. And this is accumulated from all the assets they own. They have properties, they have corporations, they have holding companies, they have stock portfolios, RSPs, RIFs. It all adds up to $1 million. The question is, how do you pay for this $1 million? Because you can't always eliminate a tax bill. There are strategies to help minimize taxes, but you can't always get rid of the tax bill completely. So you need to come up with a way to address whatever your estate tax bill is going to be. Now, if someone were to rely on their RSP or their RIF to pay this tax bill, these are registered accounts. They are fully taxable when someone passes away. So you would have to have actually over $2 million in your RSP or RIF that you haven't touched during your lifetime just to lose $1 million in taxes when you pass away to pay that $1 million tax bill. So this is a very, very inefficient use of your money. It's a waste of money. It's a terrible strategy, but a lot of people don't realize how taxable their registered accounts are. Now, secondly, you can look at a loan. But I always ask the question, obviously, what's the interest cost? Who's going to get approved for this $1 million loan because you passed away? So now who has to actually go through the underwriting to get approved for $1 million loan? I don't think that's a very ideal situation, although technically you could use a loan to pay $1 million. You could sell a property. So maybe you have a few different properties. You could sell one to try and net the $1 million. You may have to consider capital gains taxes on that property, timing of the market, putting your family through now having to fire sale an asset that come up with the liquidity your estate needs to pay the $1 million tax bill. And you could also use cash. So if you had $1 million in cash, there's no tax on cash when someone passes away. So you could tell your executor, take the $1 million to pay the $1 million. And it's true, it's only cost you $1 million to pay $1 million. So out of these four options, cash does seem like it would be the cheapest or the best option. But I would still argue that using cash to pay a tax bill in your estate is still a complete waste of your own money. There's going to be a fourth, far more efficient option, and that's going to be purchasing a whole life insurance policy. So I'll give you an example. This is a 50-year-old joint last to die policy, which means the $1 million pays out on the second spouse passing away, because if you do have a spouse and you pass away, assets can roll tax-free to your surviving spouse. It's when both spouses pass away and the assets go down a generation, that's when the taxes are triggered. Or if you don't have a spouse, same thing. When you pass away, it's called a deemed disposition. So it's essentially like the CRA treats it like you've sold everything you own, even though you actually haven't sold it. So the joint last to die policy for $1 million on a 50-year-old couple would be a solution that when the second spouse passes, the $1 million gets paid to pay this tax bill. Now, premiums could be anywhere from about $21,000 a year upwards of $57,000 a year. And I'll explain why there's such a range in premium. Now, this couple could also do what's called an offset, so which means they pay, let's say for 12 years, $21,000, which equals $252,000. So if we stop right there, what they've done is they've put up $21,000 for every year for 12 years. They've put their policy on offset mode, which means their own cash value is continuing to pay for premiums, assuming that it keeps up with the dividend. This isn't a guarantee, but this is just an illustration. But if you do the math, they've put up $252 to solve a $1 million problem. So right there, they've saved $748,000 because out of their bank account, they've only actually had to write a check for $252,000. The other thing is, in that 12th year, because this is a whole life policy, the cash value, so the CSV, again, this is an approximation based on the current dividend scale, but it could be upwards of $348,000. So they've put up $252, they have $348 in cash value that they can use during their lifetime. They don't have to wait 12 years to use it. I'm just showing the year they've stopped paying with what the CSV could be worth. So this is obviously a far more financially sound and efficient way to use your money. Even if you had $1 million in cash, I would say, why don't you take about a quarter of that, keep it aside, slowly drip that into a policy, and then spend the other $750,000 during your lifetime. Now, if someone wanted to go with the $57,000 option, again, they could put in money for 4 or 5 years and do the same offset, and the numbers are going to be pretty similar. But this is going to be the best bang for your buck. You're going to put in money into a whole life insurance policy, which is essentially buying a future amount of money you're going to need at a significant discount today. So if the need is $1 million, the premiums would not cost nearly $1 million, or else that makes no sense. You're going to get a significant discount on that future amount of money you need, but you can also use the cash value while you're alive. So whatever your estate tax bill is, look at all the options, but I can almost guarantee that mathematically this is going to be one of the most efficient uses of your dollars. And that way you can spend pretty much wherever you want during your lifetime. You don't have to be concerned with keeping assets in your estate, or just not spending assets to have enough liquidity for that $1 million tax bill.